So, very good morning. Now it's the time to deliver a keynote address on that financial management, climate finance and Viksit Bharat. So I feel really privileged to address these August gatherings on this topic, which has a profound implication on the notion of developed India. Now you know that India has begun a historic journey to become a developed nation by 2047. That's the centenary of our independence, and this is a vision which has been articulated by our Honorable Prime Minister as Viksit Bharat. Now what I will do, I will try to discuss here, because I am a man of finance, so I will try to discuss first the financial management, then I will try to align this financial management with corporate finance, because these two are the pillars of economic development, and then I will try to connect these two things for Viksit Bharat. So you know, this vision is not merely about economic growth, Viksit Bharat, it's about building a nation that is financially strong, socially inclusive, environmentally responsible, and globally competitive. Now to achieve this aspiration, we must align our financial institution, financial system, financial policy and economic policy, and with these two parallel foundations, that is, one is financial management and another is climate conscious financing. So in this regard, I can recall one famous comment made by UN Secretary General Antonio Guterres, and that comment seems to be very pertinent. That is, the future will belong to those economies that align finance with climate and sustainability. Now first I would like to explain what is financial management. That is the basic thing. Financial management is the foundation of economic growth, as I have told you. And this financial management lies at the heart of all economic activities, whether in government, corporation or household sector. The principle remains the same. That is, we have to mobilize fund efficiently, we have to allocate this fund judiciously, and you have to manage risk prudently. Now, if I discuss financial management at macro level, so to develop the economy of our country at macro level, what should be financial management? The first thing is that you have to mobilize savings from household sectors and from institution. Institution means, I am not telling financial institutions. Institution means some institutions, suppose university, hospitals, they will have that endowment funds. So you have to mobilize the savings from household as well as from those institutions and channeling them into productive investment. And the second objective is to ensure that optimum allocation of scarce resources, scarce financial resources among different sectors of the economy. It can be infrastructure, manufacturing, education and health. And finally, you have to maintain this financial stability. But at micro level, what is financial management? Now those who are from commerce background or finance background or economics background, you will be knowing that as a financial manager of a corporate sector, what are the different objectives? Means the financial manager has to take different financial decisions. First decision is the capital budgeting decision, then capital structure decision, and then dividend decision. Another decision is also there, but what I am telling, these three are the crucial three financial decisions. Now, commerce students will know what is the balance sheet, because balance sheet and income statement is published in annual report. Now, if you see the balance sheet, one side of the balance sheet there will be current assets and fixed assets. That will give you total assets. But if you know the accounting equation, total assets should be equal to total liability plus equity. Liability means the current liability and long-term liability and the shareholders' equity. Now, from this balance sheet, you will find there are different assets. Some can be tangible assets, others can be intangible assets. Now, the question is, If you open the annual report, you will find the balance sheet. But just overnight, you will not get the asset in a firm. So behind the background, financial manager has to take the decision. Now, what long-term investment should the firm choose? How the decision is taken to accept a particular project? That is called capital budgeting decision. Now, once the decision is taken, then the next thing is that how to finance that investment projects. That means capital structure decision. So, should we raise debt capital or should we use equity capital to finance these projects? This is simply called capital structure decision. And the third one is the dividend decision. Dividend decision means, in brief, I will tell you, because we will not have much time to explain all these things within this short period of time. So dividend decision means if I earn profit as a financial manager from this company, now I have to decide which portion of the profit I should distribute as dividend. So whether I should distribute profit as dividend or I should retain that profit for the future expansion of this business. So that is called dividend decision. In detail I will discuss later on. So mainly here, corporate finance managers will address these three decisions: capital budgeting decision, capital structure decision, dividend decisions. Now, how to take the investment decision? That is the capital investment decision. Now, you know different evaluation criteria are there. I will not discuss all these things in details. You will find NPV, IRR, profitability index, and payback period. Now, the best method is the NPV method, based on which one can take the decision whether a project should be accepted or it should be rejected. Now, how to select a project based on NPV method? That means I will not go in details because we don't have much time. So based on NPV method, I have to find out of a project what is my NPV. If the NPV is positive, you have to accept these projects. Now, when you will calculate this NPV, one factor is that we will get the cash flows of a particular project. Now, how to get the discounted present value of this cash flow? So here, to estimate the discounted present value, we need one hurdle rate, that is the cost of capital. Now in finance, how to estimate the cost of capital? One important method is there, that is the CAPM method, capital asset pricing model, given by William Sharp. And from that equation you will get, means cost of capital, that is the minimum rate of return expected by the investors. That should be, one portion is the risk rate of return, and another portion is the risk premium, and that risk premium depends how much risk is associated with a particular project. Higher the risk, higher will be the risk premium demanded by the investors. So another method is the Farmer's three factors model, etc., etc. But here this is mainly considering the business risk. It is considering based on the market risk, small firm risk, value effect, etc. But climate risk we are not considering. Now another method is there, that is the financing decision. How financing decision is taken? That if you decide that okay, this particular project has to be accepted, then should we go for debt capital or should we go for equity capital? Now if you finance the particular projects by debt capital, that means you have to distribute, you have to pay the interest on it. But if you finance this project by issuing equity capital, you have to distribute dividend. Now dividend is a part of profit. If you don't earn profit, you cannot distribute dividend. But in case of debt capital, you have to pay interest to the debenture holder. Now whether you will earn profit or not, irrespective of the profitability of the company, you have to pay interest to the debenture holders. So interest is a financing expenses, and that interest is charged in profit and loss accounts before paying the tax. So if you have debt capital in the capital structure, you have to pay interest, and since this interest is deducted before tax, so your taxable liability will reduce, so you have to pay lower amount of tax. Since you have to pay lower amount of tax because of debt capital in the capital structure, so you can save some savings, and because of that tax savings, you can maximize the value of the firm. That is the objective of the financial manager. So if you have debt capital in the capital structure, you will be able to maximize the value of the firm. And there is a relationship between, so value of the levered firm, that means which is having debt capital in the capital structure, is more than the value of unlevered firm when there is no debt capital in the capital structure. So it can be proved also that value of levered firm will be, so pointer is there here, I don't know, not there. So value of the levered firm will be greater than the value of unlevered firm, and you can say value of the levered firm should be value of unlevered plus the tax shield. And you will find here graphically that if I show the debt capital along the horizontal axis, so if I don't have debt capital in the capital structure, the firm will be completely unlevered. In that case, what is the value of the firm? That is the value of unlevered firm. Now, if you have debt capital, you can save tax, and that tax savings will help you to give the value. So, if you have more and more debt capital in the capital structure, so this is the present value of the interest tax sheet. So, if you have more debt capital, you will be able to maximize the value which is determined by the along with that vertical axis. So, here what I am telling, that value of the levered firm should be equal to VU plus tax sheet. But after a point of time, what you will find here, that if you have more and more debt capital in the capital structure, then the firm will be exposed to financial risk, and because of that financial risk, there is a possibility of financial distress, and that financial distress, which is happening because of more debt capital you are using in the capital structure. So this will reduce the value of a firm. So ultimately you will find, after a certain point, value will be maximized. But after some point, what you will find, if you have more and more debt capital in the capital structure, so present value of the financial distress, it will reduce the value of the firm. So from this graph, you can say what is the maximum value at what point of debt equilibrium. So when the debt is this percentage, I will get the maximum value. So that is the optimum debt capital. So this is the traditional concept of financing decision. And what is the traditional concept of dividend decision? That there are different theories are there. Miller hypothesis is there. According to them, that whether you will distribute dividend or not, it doesn't matter, because value of the firm is maximized. It is determined based on the investment decision. But another school of thought is there where Walter's model is there. Professor Walter, Professor Gordon, they have given that idea that if the firm is generating rate of return which is greater than the cost of capital which is demanded by the investors, then we should not distribute any dividend. Whatever profit we will earn, we should retain for the future expansion of the business. The condition is that if R, that is the rate of return, which is greater than the cost of capital. But when R, the rate of return is less than the cost of capital, then you can distribute whatever profit you have earned as dividend. But other theories also there, we will not discuss in details. So that is the traditional concept. So I have already discussed 3 different financial decisions. Now I will try to bring what is climate finance. So how to understand the climate finance? Climate finance, here you will find that climate finance simply refers to the flow of funds to different activities that mitigate greenhouse gas emission or help adapt to climate change. Now, it's a flow of funds to different activities. Now, where from this flow will come? It can come from different international sources. One can be multilateral institutions like World Bank, ADF, Asian Development Bank, or there is Green Climate Fund. So they will provide some fund which can be used to mitigate the greenhouse gas emission. Second source is government, national government, that is called public finance. So government can spend on renewable energy or green infrastructure and disaster reliance. And the third thing is the corporate sector. Corporate sector means private corporate sectors. You will find corporate sectors also invest in low carbon technology and sustainable business models. Now what I will discuss here, that part only, private finance part, that is called corporate climate finance part, which aims, you don't have the pointer. Okay, fine. So we'll discuss mainly the private finance, that is the corporate climate finance, which aims to invest in low carbon technology and which will operate on a sustainable business model that balance profitability with environmental responsibility and social responsibility. So we will concentrate only for that part, private corporate finance or climate finance, you can say. So what is the changing role of corporate finance? So the traditional objective is that we have already discussed. That first objective is the investment decision, which particular project to be accepted. Then how to finance this investment. Finally, how to distribute profit. But here, whatever decisions you will take, your ultimate objective is to maximize the value of a firm. And that value of a firm should be equivalent to the value of shareholders, who are the real owner of the company. That's the basic objective or goal of the corporate financial managers. That is the traditional goal. But here, when I have to align this financial management with corporate finance, then we will see what is the goal here. you will see it here. So what is the transition point? So whenever you will take the investment decision as a financial manager, financing decision or dividend decision, you will find every decision will affect the climate. Any decision will be taken by the financial manager, it must have that implication on the communities and the country's long-term competitiveness. So what you can say, in fact, every financial decision of a firm has a carbon footprint and a climate implication. So if I am a general, simple financial manager of a corporate sector, so my traditional role I know, but whatever decisions I will take as a financial manager, it must have the impact on carbon footprint and the carbon implication. So the decision now I have to take not only for the value maximization of the shareholders, but to maximize the value for all stakeholders, because it has the implication on carbon footprint and carbon application. So to reduce this carbon footprint, corporate financial managers now should try to design the financial objectives, financial decisions strategically, so that to create the value not only for equity shareholders but also for all stakeholders, employees, customers, society, governments, all the people, those who are living in this society. So now if I find out, or if I look at that financial decision through a climate lens, then what is the investment decision? I have seen the projects chosen based on NPV IRR or some different methods as a traditional financial manager. But if I have to look this financial decision through this climate finance view, then I have to go beyond this traditional metrics of NPV IRR and profitability index methods. So I have to think about this climate risk. So climate finance integrates climate risk and the sustainability benefits into investment decision. So here the traditional view I will see when I have estimated as a financial manager what is the rate of return which is expected by the financial manager, investors, that should be used as the hurdle rate to evaluate the projects. So the simple decision I have taken or estimation I have done based on the suppose 3 factors model where climate risk is not there. But if I believe that no, climate risk is there and that should be incorporated in the estimation of the cost of equity, so I will consider one factor climate risk and then I will estimate what is the expected return, which is nothing but the cost of capital. Now if there is if mathematically if you find HT is statistically significant and positive, then I can say investors here you will demand extra return for this climate risk. So what I want to say, without considering climate risk, suppose the cost of capital or the rate of return required by the investors will be 10%. But if investors demand extra premium for this climate risk means for any firm which is exposed to climate risk. So if the investors demand extra premium for this climate risk, suppose 2%, then they will demand not only 10%, they will demand 12%. So using this 12% cost of capital or minimum rate of return, we have to evaluate the viability of a financial projects, and then without considering that suppose I have decided that project should be accepted, but if I incorporate these things, since it will increase the cost of capital which will be used as a discount rate, then actual value may reduce. So NPV may be negative. So we have to consider these things. So when I will consider climate risk, climate finance, then again I have to find out what is the desirability of a particular project. Now, here the climate finance consider other factors also. Suppose carbon pricing. I don't know whether you have heard about carbon pricing or not. It's a policy approach that assigns a monetary cost, carbon tax. That means if a firm, corporate sector emits carbon, then the government will charge extra cost, and that is popularly known as carbon tax. So if there is a carbon tax imposed by government to that particular firm which is exposed to financial cost, financial risk, that carbon risk, then it will have that impact on that value of the firm. So government will encourage the business and consumers not to emit the carbon. Rather, corporate sectors here should be encouraged to reduce the carbon emission. Otherwise, they will have to pay higher amount of carbon tax. Now, earlier I have discussed what is financial decision here. Now, I can show you that financial decision or capital structure will shift. How the capital structure will shift here, I will not discuss here in details, but I can tell you that different researchers, they have tried to find out the relationship between long-term debt and climate risk. And it is observed that this coefficient beta 1 is negative. That means in simple word it can be told that if the firm is exposed to higher amount of financial risk, then the firm is going to reduce the long-term debt because there is a negative relationship. So if the firm is having more climate risk, then it is using lower amount of debt capital in the capital structure. Clear? So that findings you can get from the different publications or studies. Now, this why the company is reducing the financial leverage, or they are reducing, they are having lower amount of debt capital in the capital structure. That can be because of higher operating costs, that can be because of larger expected financial distress. And these two will be coming from the demand side, and another can be from supply side that I will not discuss in details, but I will tell you that so here you will find because of that climate finance, there will be a shift of capital structure. So traditional concept is that if you look at a balance sheet, you will find liability side, there will be bank loan and conventional debt, and there will be equity. So this is my total equity plus liability. But when climate finance is considered, then you will find this side like the green bond, sustainable linked loan, ESG funds, etc. So there has been a shift in the capital structure whenever climate finance is considered by the financial manager. So third thing is dividend decision. Now dividend decisions, I have told that you have earned profit. Now which portion of the profit should be distributed as dividend? Now that is based on return or assets and the cost of capital as per different models. But if you consider climate finance, then you will find climate conscious firms often retain higher earnings for the reinvestment in renewable technology and energy efficiency. And I can give you one example. Infosys reinvesting the profit, whatever profit Infosys company is earning, say a part of the profit of Infosys, this company is reinvesting to achieve carbon neutrality. How? Because the portion of profit they are not distributing as dividend. Instead of distributing dividend, what they are doing, they are investing this profit to some NGOs, those who are working in terms of carbon emission. So they are allocating their funds. Instead of distribution of dividend, they are reinvesting this profit to some NGO who was the different NGOs which are working on that environmental projects. So in this way, they are trying to reduce the carbon emission. So that example is there. Now I will give you different examples that how corporate sectors have aligned financial management with climate finance. Some examples are there. Leading Indian companies are already setting different examples. That you see, Tata Steel is investing in low emission steel production because corporate sectors have already started investing in different projects which are considering that climate finance. Tata Steel is investing in low emission steel project. Reliance Industry plans to invest this amount in clean energy ecosystems. Mahindra & Mahindra has launched India's first carbon neutral manufacturing facility. And Infosys and ITC also have achieved carbon neutrality. You know what is carbon neutrality? That means if I emit 10 metric tons carbon dioxide because of my business activities, because of my production facility, etc. Now I should do something so that I can reduce that carbon emission. So Infosys has already achieved that target by different activities. ITC has already achieved that target. So that's why it is, they have already achieved this carbon neutrality. Now NTPC and Tata Power, we know traditionally they used to generate power using coal, but they have diversified that activities. Nowadays NTPC and Tata Power, they have diversified into renewable projects also. Solar energy, wind and hydro projects they have started. Considering what? Considering this climate factor. Now, Indian Oil Corporation has invested huge amount in green hydrogen biofuel. You know what is the objective of Indian Oil? To refine the raw crude oil. Now, when you will refine, you need the power. So earlier, only biofuel was used by that Indian Oil to refine the raw or crude oil. But now they are using hydrogen. They are using biofuels. So even they are also conscious about the climate finance. And now there should be some institutional innovations which can reduce this carbon risk or carbon emission. You see, there should be establishment of green band and sustainability fund. Now already you will find some banks, suppose SBI is having one window which will look after only the green projects. Yeah, but what we demand that there should be a complete green bank in our country. There should be complete sustainability funds which will look into only that projects. If this project is invested, if it is accepted, then it will neutralize the carbon emission. So till now there is no banks like that. Now there should be development of carbon trading markets. What is the carbon trading market? I will tell you. What is carbon trading market? That suppose regulatory authority or government will set up that this particular company can maximum emit this much carbon. Suppose 10 metric tons carbon dioxide is permissible limit. Now I am running one business. I have the factory, I am producing product. So if I am able to reduce this maximum limit, so I have been able to produce my product within 8 metric tons carbon dioxide, then I can earn 2 credits. Similarly, if one company has not been able to generate or to emit that carbon and their total carbon emission is 12 metric tons, so they will have the debit balance and I will have the credit balance because I have been able to reduce the limit. I have been able to generate or to produce the product within and means emitting maximum 8 metric tons, but my permissible limit is 10 metric tons. So I have earned 2 credits. Now, if there is a carbon credit market, it has not yet been developed in our country, but in Europe and America it has already started. So whatever 2 credits I have earned, I can sell to the market. And those who are having the debit balance, those who have already crossed this limit set up by the government or regulatory authority, so those company has to pay money to me and I will earn profit because I have been able to reduce the carbon emission. Clear? So this is called carbon trading market. It has not yet been there in our country, but people are discussing about that we should develop this carbon trading market. Now again, there should be adoption of ESG accounting and disclosure. Now ESG accounting has not yet been adopted and disclosure etc. But now, right now, SEBI, you have heard about SEBI, Security Exchange Board of our country, that is India. SEBI has given the instruction that 1,000 companies which are having maximum market capitalization have to report the ESG score. So we are having thousands of companies, but 1,000 companies at least have to report. 1,000 companies.